Yo, 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 yo. We are back again. And 1 second. Okay, so yesterday wasn't a great trading day. I think we lost our trade. I don't know if we entered twice or once or a couple of times. Either which way, trade set stop loss. We was not able to get in. Our entry model didn't allow us to get the best opportunities for an entry. We did get direction correct, so we were predicting where price was going to go, which is this move from Wednesday all the way to this kind of low down here. So we're going to reanalyze the markets and the pairs. So I'm going to remove all the drawings, and then we are going to analyze the markets. So we're going to start off with EU right here. And you already know how we do it. So the reason why I reanalyze the charts, because sometimes you may see something differently with a new mindset. A lot of times when you have like a not so good day of trading, it's good to reset your chart so it doesn't look the same. When it doesn't look the same, it allows you to kind of get that fresh kind of I guess outlook. So we'll start off with the weekly. Already know the drift. There's two things we look for is the swing highs, but we're not going to really regard external liquidity that is too far away from price. This is quite far away. This is at 1,208.26. Price is coming at 1.17. That's a big difference, right? So what we're going to do is we're going to ignore for now the higher ones, but we're going to mark the key ones. So yesterday we had this daily high, and yesterday we had this daily low. So we're going to mark these as such. So it's the daily low with the templates, and this is the daily high. Our templates are just literally the words, so we can see which external liquidity is. Then we go to the 4 hour, and we want to mark off the 4 hour swings. So what does that mean? You can see charts, generally speaking, they move like this, right? Sometimes it's in trends, sometimes it's not, right? So I started off with no trend, and I went into high highs, high lows. Each point is a high and a low, right? But the market, generally speaking, looks like this. So you're going to mark basically the extremes, almost the extremes in relevance to price. So, for example, this is a swing high, this is a swing low, this is a swing high right here, and we're going to ignore this swing low just because there's a daily low around it. So we're going to mark this one instead as the 4 hour high. That's the one we're going to kind of regard instead of anything else. You can regard this as a 4 hour low, but we're just going to keep this daily low because it covers kind of the same area anyway. So we're just going to not ignore it, but we're going to acknowledge it in that format anyway. So these are the ones closest to price. No matter what, let's say for example, there is obviously external liquidity over here, and there's some external liquidity over, like, let's say even here. If it wants to go here, or if it wants to go here, it's got to go through the daily high or the daily low. So that's why I'm going to only regard for now the closest ones, because it is very unlikely. Like if you look at generally the biggest of candles, um, like this is the biggest one right here, which is about 230 pips. So if you take it from where price is at, 230 pips, to be fair, could account for those two things I drew here, these two places. But if you look at the average, like width, like the average, I would say, well, not average, but like the biggest that you generally get without like influence is about 60 pip day. So a 60 pip day is going to take out the daily high or the daily low, right? So we don't need this. And the reason why I like to declutter, I do like to draw up my charts a lot so people can understand what I'm saying. But I do like, for my own personal trading style, I like to keep the charts as clean as possible. So we have some equal lows over here, and we have the daily low over here. So once you've marked off external liquidity is those things that I've mentioned. You then want to open up. I like this indicator. It shows the sessions, right? So you have 3 sessions: Asia, New York, and London. Not in that order. It's actually Asia, London, New York. And this box shows you the range in terms of height, the minimum or the low, and the high, and then also shows you the time, or if you could x-axis, which is how long it's been in that session for. So Tokyo session creates a range for us. We use this to showcase the liquidity, and red signifies if it has been swept, and green signifies if it has been if it's sitting there. So we have liquidity sitting at Tokyo session. We have Tokyo lows over here that have been swept. London lows, which have not been swept, which actually almost line up with the daily low. And then we have also, wait, I wasn't meant to take the whole thing. And then we have London highs, which are just about being swept by New York. So what does liquidity sweep mean, right? So this is all of our liquidity done. We've done the external liquidities, and we've also now done the internal liquidity. So external liquidity and internal liquidity, what's the difference? External is our direction target. Okay. So if I even get such open docs, we can actually start making some notes. So direction model. The direction model is how we choose what external liquidity price is going to before price gets there. Why is that last bit here added? Well, there's no point in predicting direction if price is already there, right? So you kind of want to, I guess, predict it before it happens and then make your move. Of course, sometimes you may not be able to. Sometimes it's already got there, but by the time our direction model rules have been set. Quick note, side note is that we have news at 1:30 for USD, and then we have news at 2:45. So this is going to be a very busy day for USD. So expect this whole kind of afternoon, evening for us to be on the charts, generally speaking. Okay, so the direction model, like we said, is how we choose. That's what it does. It's how we choose which external liquidity. So we're not even forget about internal liquidity now. It's just external liquidity that we're focusing on. We're focusing on which one price chooses one of the ones it wants to go to at delivery, before delivery rather. Okay, so that's the first point, is where we're going. Internal, it's actually different shape. External liquidity is the liquidity we are targeting, where, give me a second. Open up my previous notes so I can properly make this up. So we need another one for entry model. We'll get to entry model later. Okay. Okay, so if I let's define what external liquidity is. External liquidity is a level, right, that would force traders trade in higher positions, or not higher positions, force traders trade in, force traders hold in positions from a higher time frame to be closed. So what is that? What does that mean? So internal liquidity is basically liquidity on the smaller time frame. External liquidity is liquidity on the higher time frame. The difference, or what makes external liquidity and not just an area or a random area, is where people that are trading, for example, if you're trading the daily, you're entering the sell, you'll probably have your stop loss over here, wherever your TP is. Forget about where your TP is for now, but your stop loss will be above this. Why? Because that is the peak. That is how traders trade. Meaning institutions want to take out this stop loss. Why? Because it gives them ability or liquidity to then fuel their moves. Because for them to buy, they need people to sell at this area. So if I want to buy this and my TP is up here, I need someone to be able to take my holding or my position out of my hands and into theirs. So they target people that are in this position, and it's gonna be a lot of them. Why? Because it's a clear and obvious area to multiple types of traders. Retail traders are like a hive mind. They think the same. There's things in the charts that no matter your strategy, you can see. Like I know high highs, high lows. That's how I used to trade in the past. I don't utilize it in the same way as I used to. That used to be my whole direction model, but it's now more so a confirmation / an entry model. more so. Not I don't use it to determine direction, because you can have higher highs, higher lows, and price doesn't continue. You can have higher highs, higher lows, and price continues, but you sometimes even still fail to enter. You can have the market that's moving sideways. You can have a market that is just all over the place, but you want to be able to make money across all forms. And if you're trading one pair and you're waiting for high highs to high and high lows to form, for example, let's say I was waiting for this on the 4 hour time frame for all this to happen, it'll take a very long time before I enter a trade. So I would like to, first of all, I do think it's a misconception when you use it as a core sense of your model, but I do think it's a tool that can help you. So that's what external liquidity is, which is why we target it, because we are following the basics of this, the principle rather. But okay, there we go. I'm gonna put it here and then wait. Okay. The principle behind this model is to follow the footprints of institutional traders. So hedge funds and banks, etc. The principle behind this model is to follow the footprints of institutional traders, hedge funds, and banks, etc., with the belief system that the markets are algorithmic and not random. Why is this key? So the principle I've said here is behind the model of our trading style is that first we're following the footprints of institutional traders. It's difficult to know. I don't have inside information. I do not work for a company or a bank or a hedge fund or something. So I don't know how they trade. But what I do know is what they're looking for. And when you know what they're looking for, you can kind of gauge. This is the example I gave yesterday, and I think a couple of times even. If I'm trying to track somebody down, I need as much information as possible. Let's say it's a random person. It's like a challenge. I need to find out where they are in the whole world. But we're both starting in the UK in random points, and I know that they're trying to hide from me. Okay, there's no chance on this planet I'm gonna find somebody random in this country without me having at least some clues. So that's the first clue, is that you need clues. That's the first thing you need to understand, is that you need information. Information is what we call clues in this example. Information gives you or gets you closer to a goal, right? That's what you need, information. That's good information. Bad information is it takes you further away or keeps you stagnant. Anything that doesn't take you closer to entering the trade and making money is bad information. So I don't care about indicators. Why? Because it doesn't help me get closer to my goal. The only indicator I use is information, or information such as, the only indicator I use right now is the sessions marker, just because I don't want to have to line up my x-axis a lot of the times. It just helps me see the sessions easier, right? So every tool I have, every indicator, every information should help me get closer to the goal, right? So, hold on, let me see if I want to include that. Okay. A good direction model is made up of information that takes you closer, that that's the basics. Obviously, a good direction model is what helps you get closer to choosing, know where the price is going. Okay, and then we're gonna say good information is something takes you closer. Bad information takes you further away or keeps you still. Just keep stagnant. What does that mean? Like I said before, hello. Good information takes you closer, so closer to where price is going, and bad information takes you away or keeps you still. So things like uh, indicators that provide no value. That's an example. So the direction model is how we choose what the external liquidity price is going to before the price goes there. External liquidity is a level that would force traders holding positions from a higher time frame to be closed. That's our definition of external liquidity. Okay, and internal liquidity is the same but on a small time frame. So what we can actually even do is copy this, paste it, and then just change this to lower, and that's literally the difference. Okay, so we have the liquidity marked, right? I think that's a good denomination of introduction to the direction model. Then we need to, once we have okay, I think we need to know why we need a direction model. Well, we've kind of started it. Okay, let's add it here actually. Let's using this principle to infer the areas which institutions are targeting. Okay, good. So what this extra bit added, so having a direction model is using this principle to infer the areas which institutions target. It's basically saying that because we believe that the markets are not random, and because we also believe that there's institutional traders, and because we believe that those traders are algorithmic or their markets are not random and they have an algorithm to how they process. Algorithm is another word for system. Because of that, we then believe that they have areas that they're targeting. Because of that, we then can infer the areas they're targeting because of the things they look for and need, right? It's a mixture of they have to have, like, if I want to buy something or if I want to sell something rather, there needs to be someone buying it. Otherwise, I'm not a seller. I'm just a person I'm a lister. I list my item for sale. I'm not a seller. A seller is a person that actually has people buying it. So for institutions, billionaires, millionaires, big companies to be making money, they need to sell something to someone that's buying it. That's what makes them money. So that's something that they cannot change. So no matter how much, let's say I want to buy 1 trillion Bitcoin. If there's not 1 trillion Bitcoin, I cannot buy 1 trillion Bitcoin because there's no one selling that. And the same way, if I had a trillion Bitcoin and I wanted to sell it all, that's why companies cannot just sell sometimes all of their stock at once. They have to gradually do it or sell it to the crowd, for example, because you still need supply and demand. Like everything is ruled by supply and demand, and you can always break something down to such. So having a direction model is us basically saying that, okay, this principle exists or these types of people exist, and we're going to use that principle, or based on that principle, we're going to try and determine where these guys are going to be targeting. We come up with the theory that they were targeting external liquidity. Why? Because they have to have sellers, or rather buyers, for their positions they're trying to sell. So that is why we get our information, or why we use liquidity to kind of gauge. So I want to make a quick statement just after this definition. So price moves through internal liquidity to external liquidity. Make it capital I. It's a keyword. You know, I might even keywords I'm going to highlight. Okay. Blue or red? I think blue is Loki aura. I'm not gonna lie. Nah, blue's aura. About grey. No chance. It's too light. Let's go pastel blue. Too light again. Yeah, that's all. All right. Okay. So price moves through internal liquidity to. It's not the same. Here's one step back. To external liquidity. Okay, cool. That's that step done. We'll keep an eye on price as we're doing this, by the way, so don't worry. Okay, London swept Tokyo. Okay. So now we've described what, like, we kind of explained what direction model is, why we need one, and some keywords, right? So now we want to go through how price actually does it. So the first things that we need is to mark this up. So we're gonna take this, separate this to then be actionable steps, or yeah, actionable steps. Okay, so this will be separate to information. So actionable steps, I like there's a thing where you can check it. Hold on. Like this, yes. Let's separate this, make this a new page. Okay, actionable steps. So step one, mark is what we just did, right? Is to mark external liquidity. And internal liquidity. Wait, there's liquidity. Okay, there should be a way to change this. Okay. Okay, so markets and liquidity. So weekly highs. What else? Daily highs and lows. 4 hour swings. And then equal. So external liquidity is weekly highs, lows, daily highs, lows, 4 hour highs, lows, equal highs and lows, right? Internal liquidity is the same thing, but it is going to be things like session highs. Oh. Intraday swings. And then minor 5-minute structure. Okay, you see smaller time frame, larger time frame. It's similar processes though. So this is the first step. We're gonna call this liquidity markup. Yo, this is great content, by the way. I'm not gonna lie. Okay, we swept. Hold on. We've swept this. There's a way for me to change it red, maybe. Should we change it red? Yeah, let's change it red. But no, not the text. Okay, this has been swept, which is the 4 hour high. Like I said, sometimes it's possible for price to get somewhere before direction is chosen. Okay, cool. So, direction model we've explained a little bit. We've also started the actionable steps. The first part is liquidity markup, which is where we mark. Oh wait, news just hit. Sorry, we got to put down pause. Okay, so we have mixed news, but price is just going to take us to liquidity. So GDP is probably dropping. Changing price. So prices have gone up. Okay, cool, 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 cool. So yeah, we've had this sweep. We still don't know direction yet because this is the Judah swing time frame. New York Open, we avoid the first 30 minutes no matter what. This is now liquidity sweep. So we swept Tokyo highs. We already swept London highs at open. We'd also swept Tokyo highs here, and we've also swept these 4-hour highs. So it's a lot of external liquidity that we've gathered. So now what we'll be looking for is a displacement to the downside, and then a retracement to either 50% or a fair value gap if it so pleases, and then a retracement to such, and then we can get in. So generally speaking, because I can see that we've swept the highs, I'm going to ignore that. Now I can see we swept Asia lows. I can see that we swept London highs and Asia highs with this move, so I'm going to leave that. But we're going to just keep monitoring this for like the next 15 minutes. But generally speaking, you don't want to know. I mean, don't want to enter. What we now look for is acceptance. So I'm skipping a little bit of the direction model, but after we've seen the liquidity get swept, we then look for the acceptance, right? Which is displacement and well, acceptance followed by displacement, followed by retracement. Then our entry model gets put into effect. So obviously the candle hasn't closed yet, but yeah, we'll just monitor this for now. But what we would expect was what we've seen multiple times is a sweep and then a displacement downwards to the downside. So right now we're leaning towards this daily low, which lines up with this liquidity London lows here that are to be taken. So this might be a continuation day, but we just had to consolidate, gather some liquidity before we drop, which happens in days like this. Gather liquidity, accumulation, bam, drop. Consolidate, gather liquidity, bam, drop. So we'll see. Obviously, it's not set on stone yet, but that's what we're going to be looking for. Cool. So back to the direction model, right? So we've already done the markup on EU at least. We've done the daily highs, 4-hour highs, daily lows. We've done marked in the session highs, etc., right? So we've done this and we've done this. I'm gonna make it interactable as well. So when you guys are potentially, I put this video out or whatever, I make it public, you can actually access it for free. So we've done that liquidity. What is the next step? So now we want, so call number 2, liquidity sweep. So this segues from this point to this point. So price moves through internal liquidity to external liquidity. Liquidity, let's define it, is resting orders. Such as sell side liquidity, I'm gonna make a note for myself to explain this later. I'm gonna put it here because I need to make sure I'm correct. Right. So liquidity is resting orders such as oh wait, the star makes it italic, I just realized. Best liquidity. Liquidity provides fuel for price moves. I'm gonna explain why later as well. Okay, so that, I don't know how I made it italic. Anyway, liquidity is resting orders. I like that. Sell side liquidity, buy side liquidity. This is just basically a spam of keywords. And then we can put liquidity. Let's make that blue. Oh, of course, dude. How am I missing a letter every time? Hello? Okay. So liquidity provides fuel for moves. Okay. What else? When liquidity is swept. May include. So when liquidity swept, different models are avoided. Some models will include breakout traders. I used to be one. Or but like instead. When liquidity swept, different models are avoided. Some models like breakout traders. I used to be one. Facts. Okay, so now we then segue into the steps, right? So we need a liquidity sweep, but what liquidity sweep? Which one are we looking for? So we have 3 sessions, right? Asia, London, and New York. Those 3 sessions are important. We should probably make that a part. So 3 key sessions we look at as they provide their own value towards entering towards direction and entry towards our direction and entry models. So Asia, London, New York. Asia provides ... London provides ... New York provides ... So these 3 things is what they're going to provide. I'll tell you what they each provide later. Remember, we're live trading and we are making this document at the same time. So we're waiting for the London session to perform a sweep. Let's get the checkbox. No, wrong one. I'm just gonna put some manipulation, direction. I'm gonna put just range for now. Range, manipulation, direction for now. So London session sweep. Okay, cool. So I'm gonna have to do this a little bit different here because I'm gonna have to give cases. So tick if London swept Asia highs. Tick. I'm gonna see. I'm just gonna copy this. Low and low. Stayed in Asia range. Okay. So these are going to be cases instead. So you have actionable steps. Liquidity markup is easy. 2 is going to be the London liquidity sweep, which is what the London session sweeps. Here we swept the Asia lows. Okay. And then we need to see the reaction to such. But we're going to keep it like this for now. We're going to go into this document where I'll probably make it like over a couple of days. I don't want to, like, my entries are going to be happening soon. It's a very busy day, so I'm not trying to be here all day. The second thing is, this doesn't tell us direction yet. Remember, this is all contributing to the direction model, right? So this is step 1, step 2. There's still like 2, 3 more steps, and there's cases. So just because you go through the steps doesn't mean you know, the same case can give 2 different things. But we'll kind of get into that later. So the next step, I'll go into, like I said, everything will be explained, but we're just building this. So the next step after London makes a sweep, we're gonna have, well, we'll put the reaction to the sweep or what price then does afterwards in this section. But after price then makes a move, we then wait for the New York Open, and we're gonna call this the Judas move. It's not something I coined, but it's something that is widely known as. So okay, cool. We're gonna put this here. So a Judas move is where a move, a change in price that traps traders because institutions need liquidity to enter. So this is like a basic definition. Like, what I say? Like, a change in price doesn't mean anything. Like, how would you know if something's a Judas move or not? So characteristics of a Judas move. Like, just because it's a change in price and it tracks traders, how do I know if this move is the one that's a Judas move? This is just this type of move. This is actually price deliverance. This is accepted. Like, how do I know which is which? What is a Judas move? What makes it a Judas move? So obviously it does this. That's its intention. It traps traders because institution needs liquidity to enter. So that is the reason why that is what it does. Characteristics of Judas move, time. So, how do I do this? Maybe do another line. Yeah, let's do another line. Let's do this. It tends to happen at New York Open. So 13:30 to about, just say, 14:15. We'll put this in the capital letters because it's not always going to be that. Sometimes it happens during London. Sometimes it happens in between sessions. Sometimes it happens later, earlier. It depends. Just context matters more. Well, it's normally sharp. Not always, actually. It's probably like a list format. We'll come into that later. So we're gonna go. Let's make a note. Give more characteristics. That was spelled so badly. Whatever. Okay. So New York Open Judas move. Get this. Wait. Well. Time. GMT. 13:30 to 2:15. Well, you. New York Open. Do not trade immediately. Expect manipulation. I think I need a new keyboard because my spelling is so great. Okay, cool. So New York Open, we do not trade immediately. We expect manipulation. Okay. Again, we're gonna go into that later more as we go along. So after we have the Judas move, we then have the real move. So we need confirmation of the direction is in step 4. So what is the things we need? Well, I thought it was Control P. Cancel. Control Shift 9. Okay. Confirmation of the direction. So so we need dealing range / or London high low. We need to know, and then we need acceptance, and then its nearest external liquidity. Okay, so this is the structure of the document. We are not finished yet at all, but I think we've done a good start. I'm going to go back into the markets. We are going to run step 1 through GU and then we'll leave step 1 to 4, 2 to 4 for another time. We might pick this up tomorrow. It might be on the weekend that we do this. It might be on stream. I don't know, but I'll probably record myself doing or making it. And then, okay, cool. So this is that. Next one. Okay, so let's take this and action it. Okay, so first of all, mark external liquidity. Let's go to GU. It's a clean slate now. What's some external liquidity, you're asking? Well, weekly high, low. Okay, let's go to the weekly. Okay, well, the weekly high is over here. We can mark that with the weekly high. And the weekly... let's go to the previous week. And then the weekly low back here. Well, we don't need that because it's been swept already. So let's ignore that. Let's go to the daily. Yesterday's low down here, which is also now equal lows. And then we have daily high of yesterday. So yesterday, remember, this is the daily time frame. So every candlestick represents a day. So today is this most recent one here. The day of yesterday is this one. The day before that is there. Then you can see every candle represents a day. So this is the daily high. That's the high. That's the range that we're looking at. Okay, so we've done that. The 4-hour high and low. One over there, but we're not going to mark that for now. Equal highs and lows. That's really been swept. Okay, so we've done external liquidity, so we can check that. Now it's time to do internal liquidity. So we're going to go to smaller time frame. And then I have a different system for this. This is our London high right here, which has already been swept. We do have a lot of liquidity actually over here, like a lot. And this is a liquidity pool. I'm going to put it like this. I think price is going to go down. So in this instance, there's a couple of things that we could have. We could have a high, well, the terminology, but it's like an aggressive delivery day. Essentially, well, I can explain it before actually giving the correct terminology. So a day where price is going to get to external liquidity quickly, which means there's going to be shorter pullbacks, not as many opportunities to get in. Like it's going to be like this. So a lot of the times we want to see price come up to like a fair value gap, which is a place of imbalance, where price moves quickly because that's where the footprint of an institution. So when price then pulls back to this area is where we enter, but sometimes price doesn't come back. So this is why we're doing direction model first. Entry model is going to be a very detailed. I can't like when I do the entry model, that's going to be gold because it's going to account for everything. Because when I'm making my models, I'm making it for me. So I'm making it for a way it's like I ask these questions. And the best way to ask questions is that I want to explain it to anybody, that anybody can do it. Obviously, not everybody can, not everybody will, but if I believe that if I can explain this to a child and they get it, I can explain it to an adult, they get it, then I can explain it to a woman, a man, an elderly person, as if I can explain it to as many people, it makes it clearer and it's more consumable and can help more people. So that's why I do want to go over this, and this is just number one. Like there's gonna be so much more. Okay, so we'll wait. This is generally speaking how we enter, but a lot of the times price has these shallow pullbacks. So you are in that instance allowed to go to a smaller time frame, but you'll need to first identify if it's a high impact. I've got the terminology, remember, but if it's like an aggressive delivery day. So then once you know it's an aggressive delivery day, then and only then can you then know, okay, fine. I've now established this as a daily high aggressive delivery day. I can go to a smaller time frame, the 3 minute, and look for entry models on the smaller time frames or points of interest on the smaller time frames. So this is our first fair value gap here. So we have swept the London highs, swept external liquidity here. We've displaced downwards. We are consolidating, which is also gathering liquidity. We have acceptance below this dealing range. We're below the midpoint. It opened up at this level and it went up to this high, and now we are not only below the midpoint, we're also below number one. Our entries around here, well, it's what we ideally would want. Our entry to be around here, and then us to target these daily lows right here, which is also this liquidity pool. So this will be our entry. So this is literally our trade right now that we're looking for. But the only thing we need is for price to come up to our entry, and as soon as it comes, you can even place an order, and that will be our entry, right? The thing is, because it looks like it's going to be a high impact delivery day, it also does look like price could just drop. Now, unfortunately, our entry model doesn't allow us to just get in and you know what's the word? Capitalize on such moves. But it is a disciplined rule of thumb that we must obey. So, entry model is my current weakness. So I just keep it as base, as simple as possible, so where I don't get too complicated. Because, like I said, when it's a high impact delivery day, you can then start to change some things to account for that. But it's very skill. You need a lot of skill for that, and a deeper understanding is your key to get that skill. So I don't fully have all the dots connected. So as I continue to do my research, and just for reference, the best person to listen to watch where I'm getting my information from, partially, not all of the information is obviously him, but my favorite trader, and I've been trading for how old am I? 20 for 10 years. If I could recommend one person, it would be this man right here. Inner Circle Trader, Michael J. Huddlestone, I think is his name. I think that's his name. Michael J. Huddlestone. Is that someone that? That's Mark Douglas. Okay, yeah. Michael J. Huddlestone, I think is his name. Go to his playlists and go through these ICT mentorships. If you get as much as you can consume and learn, I promise you it's worth it. And I'm also taking part as well. So this is EU. Why is this satisfied? Well, I did rush a little bit just because price is close to my entry. Number one, we've marked external liquidity. Internal liquidity, we already pre-marked. Like I don't necessarily draw as much just because I can see it. But this would be an example. Like here, we swept the London highs over here, right? And remember, there's going to be case models if London swept Asia high, which actually swept the low. So if London swept Asia low, and then there'll be a case underneath it, and I'll tell you what to look for. And then we have the New York Open Judas move. So do not trade immediately. Expect manipulation. What was that? So we opened. We didn't trade immediately. What happened? This move here. So there's some traders that would have bought this because of fear of missing out. Maybe they would have bought this, and guess what? They would have been stopped out. They would have probably been targeting up here, but guess what? It's not the time for a reversal because some breakout traders would have traded that aggressively. So they would have got stopped out. So that's liquidity, and it's also external highs over here that people that are trading the 4-hour time frame would have had stop losses over here. They got taken out as well by the breakout traders, and the breakout traders also got taken out with this move downwards. Okay, we are close to entry, so I use this website called Pip Counter to calculate pips. So our stop loss would be about 4.4 pips. So let's just say 5 or 6 with spreads. We're trading GBP, and I never. Okay. Trade. Let's get it ready. Oh. So this is 7.7. So 7.76. What does that do to us? We're supposed to enter right now. This is to 8 pips. We're just gonna enter like this. Okay. And then I'm gonna go to Telegram. Share with the boys and girls. Dun, 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 dun. So what is this? Or we've set our stop loss here. Our TP is gonna be this liquidity right here. 7 or double 2. Make sure everything's correct because I don't want to have to wake up and see my stop loss has been hit because I put the cool. So hit entry. Ideally would have wanted to get in here, but we didn't. It's fine. Stop loss is fine. I might make this a little bit tighter. That's our entry. So why did we enter this? It obviously, hopefully hits TP, but the reason why we entered is because we had a drop. Well, we had a spike up, which is what we identified as the Judas move. We then had an acceptance back into this London range, which is here. We stayed under it for 1, 2, 3, 4 multiple candles. We have a fair value gap of an area of imbalance, which we've come back up to, which is like a place of entry, and we're selling to the external liquidity, which we've determined that the price was to go down simply because of the Judas move, the acceptance, the lining up of everything, the imbalance and the displacement to the downside. That's why we want to. So why we are entering here is because we expect institutions to protect that original displacement by placing more orders here, because this accumulation, this kind of pullback is going to be people trying to buy. So there's orders for them to take out to then push to the downside. So at this point, we just sign off. We close our charts. We've entered it. Ideally, we would have got entry up here, but just for the scarrings of me losing some out on some trades earlier, I decided to just enter early, which for me is fine. So from now, we'll go into wait. I'm going to probably come off for a little bit. I might, yeah, I'll come off. Not off stream. I'm going to come off. Actually, we might end stream low key. Yeah, we're going to end it. Let's keep it short. We've entered the trade. Generally speaking, I want to trade until entry. So we've entered the trade. I'm going to post the update on my Telegram. Let me see if I can show you. Okay. This is my Telegram right here. This is the link to join. It's free. It's just a idea channel where I show my ideas and then update how much I've made and how much I've lost. Is more like a documentary. And then let me post that into the chat right now. So where's the OBS? Oh, it's right here. Boom. I'm going to pin that into the chat. I'm going to pin that in the chat. Pin message. So it's the first link in the description as well. And it's also pinned. So yeah, you can see how this trade does. I update everything. I'm fully transparent. If I enter a trade, I post it. If I lose, I post it. If I win, I post it. I'm very transparent, no matter what. So we'll see what happens here. I think this is a very good setup. I'm very happy with whatever happens. It's almost a 1 to 3. You can see prices rejecting from this area, which is a good sign. It's not obviously everything, but it's a good sign. And yeah, we're pretty much done for the day. This will literally be us. We trade, close the charts, we're off. Obviously, I traded for an hour, but if I was to hop onto the markets, let's say 1 p.m., right? If I was to enter, let's say 1 p.m., I could, external liquidity I can do in like a couple of minutes. Internal liquidity I can see pretty instantly. And then, yeah, I just wait for this move and then I'm in and out and I'm out for the day. So we're going to close our phone, close our charts and stream, and we're going to update you on the Telegram. So shout out to everyone that's come through. This isn't a good rejection, by the way, but shout out to everyone that's come through. Yeah, it's been your boy CJ, and hope to catch you guys in the next video, and take it easy. Peace.